Well, the fundamentals of the U.S. economy have not collapsed, but confidence in them has. So says Brian Belski, Chief Investment Strategist at Oppenheimer, who joins us now. Why should we expect that, given the recent sell-off, given the state of fundamentals outside of corporate earnings? Why should we expect the market to rise?
Because typically and historically, that's what happens after panics. And I think that's what we saw as a panic. Couple things.
An unjustified panic?
We think it's unjustified given the fact that so many investors are comparing what's happening right now to what happened in 2008. Why is that? Well, that was the most recent memory in terms of fear and panic. And in 2008, for all intents and purposes, was a systemic problem with the U.S. financial system. We were shutting down. I mean, there was risks and rumors of runs on the banks. That's not what's going on right now. However, the recent price performance is very reminiscent of what happened in 2008. So investors are extrapolating price action with fundamentals. That's kind of point number one. Point number two is that when you take a look at history, of course, history never portends of what's going to happen in the future, but when you have this extreme panic, it usually means that people are trading on emotion and not fundamentals.
You know, you advise people in one of your earlier notes this month to stick with their investment strategy. That is so hard to stomach right now when across the board, whether you look at Exxon, Apple, Alcoa, over the last month, they're all down more than 10%. So it doesn't really matter where you look outside of gold. Why should people stick with where they were?
The key thing that you mentioned was over the past month, right? What's the definition of an investor is in the last month? I mean, I think we get too focused in on what's happening day by day, week by week, and we really forget about wealth creation over the long term. And that's why we firmly believe that we're at the end of the cycle and a new cycle will be beginning. Think about everything that's happened recently with consternation in Washington, U.S. stocks doing what they're doing, Europe, international problems. All of this is kind of creating a crescendo, which typically happens at the end of the cycle. So what's going forward is we want to try to find those companies best positioned fundamentally. And we believe, as an investor, you always want to try to buy those mispriced assets after they've been sold off indiscriminately, and that's what's happening right now.
The sell-off was indiscriminate, as you said. It was across the boards. And you know, it's interesting, those that pick sectors like you and many other wealth advisors, their credibility is being questioned now because people are saying, look, if I'm in anything but gold, I've been losing money. Can we really predict the market in this kind of environment, do you believe?
Sure we can, because again, at the end of the day, fundamentals lead prices. Fundamentals will come through. They always have, they always will. In terms of credibility, you know, I think there's a lot of people that do what I do are either one direction. They're either always bearish or always bullish. We have a track record over the long term of playing kind of both sides when appropriate. So in fact, coming into this year, we were very cautious and we urged investors not to be as bullish as consensus was. And I think that's been a good play so far this year, to be more fundamentally disciplined, to buy high quality assets that are actually providing you with some yield and with some longer term growth.
Chance of a double dip recession in your mind right now. Nouriel Roubini has said at least 50% in the next 6 to 12 months. You on that page or a much lower percent?
No. You know, frankly, we find it very surprising, Poppy, that everyone is now in the recession camp after the market's gone down more than 10%. You know, where were you 7 months ago? That would be our comment. You know, when we entered this year, we really cautioned investors that it was going to be very volatile. We were less optimistic than most. You know, people that are throwing out percentages of recession, I think it's really difficult to do that. Have the odds of a recession increased? Yes. Can we put a 35%, 70% chance on that? No, we don't think that that's likely.
Your end of year target for the S&P 500 still 1325?
Yes.
How do we get there when, yes, corporate earnings have been beating expectations, but overall, when you just look at the market in the month, down about 15%?
Well, I think first and foremost, market bottoms typically happen in the fall. Okay? So you're going to have a lot of talk, you're going to hear a lot of talk about a September or October bottom. In our experience, you know, doing this well over 20 years, when everybody typically agrees on something, it's probably not going to happen, right? And so we would think the market's right now bottoming, or it's going to happen later in the year. Our bet would be maybe later in the year than most people are anticipating, because we still have some questions, more questions than answers out of Washington.
A bottoming out later in the year?
Yes, and then an eventual rally. You asked me how we're going to get to 1325.
Right, by January 1st.
Yes. How we're going to get to 1325 is the market has shown through times is that we've had several periods in history where we've seen compressed returns in a very quick notion. 1994 would be a great example of that. 97, 98, those types of years where the market went up very rapidly after we kind of answer some questions. And I think the big question that has to be answered, Poppy, beyond everything else, is the job situation, period.
Do you think after we get some clarity from the president, as we're expecting right after Labor Day on jobs, that's going to help this market?
I don't think it's so much clarity from the president. We need to see an implementable plan. Right? So what was great about the most recent news from the Fed was we're not going to raise interest rates or do anything to 2013. That was something definitive. Okay? What we would like to see, and we've been in print about this, is that we would like to see some sort of a definitive, implementable template plan that says exactly what we're going to do, meaning Washington, not just the president, but Washington partners with corporate America on how to instruct structural change in the employment code, meaning let's get jobs going, and we're going to do it together, and we're going to do it and announce a plan over the next 30 days. That's definitive.